So let's kick off with the investment quotes then. If you look at the famous quotes, Warren Buffett seems to be responsible for most of them. So what I'm going to do a whole bunch that Warren Buffett isn't involved in, and I'm going to give you a list of those that Warren Buffett has apparently said. Now, you've got to take what I'm saying with a grain of salt. These people are apparently attributed with saying these quotes according to various sources on the internet, but I mean, of course, some of these things can be debatable, but that's not really important. The quotes and lessons themselves are what is interesting, rather than who actually said it. So let's kick off with the non-Warren Buffett lessons first of all. So the first one, the 4 most dangerous words in investing are "this time is different." And that was said apparently by Sir John Templeton, who was an investor and philanthropist known for his global investing strategy. So "this time is different" is a thing that you read a lot, or it's implied by analysis or quotes that you see in the press. It could be, for example, the AI boom we're getting at the moment, talking about technology stocks that are soaring. So there have been comparisons drawn between now in investment markets where prices are elevated and the dot-com era. So when the bubble burst, when we got to the end of the 90s into the early 2000s. And part of that is because of those elevated prices, but also because technology stocks are driving a lot of the enthusiasm that we're seeing in investors. At the moment, it's AI stocks, so artificial intelligence related companies. Now, what you might hear are people trying to justify that things won't suddenly blow up like they did back in the dot-com bubble and then the subsequent burst. So the phrase "this time is different" refers to that kind of thing, where you're comparing a scenario where perhaps you're expecting something to happen through lessons of history. Things aren't panning out the same way as history has suggested. Yes, things can be different, things do change, but even if things are different, saying "this time is different," it's been said many times in the past and people have fallen foul of it when things like markets have corrected. Bear in mind that often things aren't different. So I'm not predicting the market's about to crash, but bear in mind, just believing that things will be different doesn't mean that will actually pan out. Next one is, in investing, what is comfortable is rarely profitable. That was apparently said by Robert Arnott, who is a pioneer in quantitative investing and founder of Research Affiliate. So this one is a good reference to the fact that you are going to have to take some risk if you want an increased chance of reward. So it's that risk versus reward balance. So occasionally it may feel uncomfortable when you're investing, but if that is the case, then maybe you are taking too much risk, but you do have to take some risk if you do want that increased reward. The problem you have, there are people out there who want their cake and eat it. They want to have the increased returns, but they aren't happy taking that extra risk. At the moment, you get pretty good returns on savings accounts. I'll just throw that in actually. There is an easy access savings account now that you can get 5% interest on. So I'll put a link to that in the show notes of this podcast. So the lesson from that quote is regarding risk versus reward. The next one I'm going to look at is the goal of a successful investor is to make money, not to be right all of the time. And I really like this one. This is George Soros. So George Soros is a billionaire investor, and he's known for his currency speculations. He once famously bet against the pound and made a lot of money. So he's a billionaire. And the point of investing is you are not going to get everything right. Sometimes you make investments and they may fall in value, but the problems only arise if you make too many of those and lose too much money on those particular investments. Now, I run a portfolio on 80/20 Investor, and I will change funds looking for better opportunities, and there will be times where I will crystallize losses. But over the long run, I have made profitable investments because I get more right than I do wrong, and I also have made more money on the ones I've got right than the money I've lost on the ones that I've got wrong. So being an investor, you're not going to get everything right, and being comfortable with that, I think, is a key part of being a successful investor. And George Soros is one of the most successful investors out there, so take his word for it. And actually, the next quote is from him, which is, "I'm only rich because I know when I'm wrong." And so that goes on to the fact that knowing when you're wrong and to cut your losses is important in investing. There are a lot of people who buy investments and they stick with them as they keep tumbling. Just because an investment has fallen in value doesn't mean it's necessarily going to mean revert. I know that happens frequently with investment markets, but something could be falling because it's actually imploding. So knowing when to cut your losses, one way of doing that is to have an investment process. We talked about process and decision making a lot on the podcast recently, but the 80-20 investor approach that I use makes sure that I'm not emotional when I make investment decisions. So I have a process where I will look at other opportunities, the performance of the investments I have, and then I will move out of that when I feel the time is right. But also, it may mean I don't get it right. I might sometimes change investments, and actually if I'd held on to it, it may have come good in the end. But often what happens is you'll find a better opportunity elsewhere that you can end up making more money on in the long run anyway. So there's been plenty of people who've held on to funds and they've ended up accruing bigger losses. Now, a lot of that stuff is obviously with the benefit of hindsight, but as a general rule of thumb, George Soros says that he's only rich because he knows when he's wrong. It's not what you own that will send you bust, but what you own. And that's an anonymous quote. And that's really talking about managing debt and leverage. So there are things like ETFs that are leveraged. So what they do is they use borrowed money to increase the returns on the investment. So you might get, for example, 3 times the movement on the spot price of gold. But that does mean you get the amplified increases in that spot price, but also the falls. So what you can do is it amplifies your gains and your losses. So leverage is, from my point of view, something which should be only used by people who are very experienced and understand it. I would never use it. And obviously CFDs are another product out there where there is leverage. So be careful. If you see the quotes that the FCA make these firms put on their sites, it's somewhere between 75 and probably 80% of customers lose money using some of these products that use leverage. So be aware, leverage can be very dangerous. Investing should be more like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. That was said by Paul Samuelson, who was an economist and Nobel laureate. I mean, that speaks for itself. Investing should be boring. The best time to invest was 20 years ago. The second best time is now. That's another anonymous quote, unknown author. I like that because that just teaches people, listen to the podcast, what will happen? People look at the market, say, going back to, it could be after the pandemic when the markets crashed and think, I wish I'd got in then. Or it could be last year when markets crashed, I wish I'd got in then. One of the lessons I've learned is that you can't time the market. I remember when I launched 80-20 Investor and I had my own 50k portfolio, it was in March 2015 and the market was at all-time highs at that point. And there was a part of me where I was thinking about, well, I'm about to invest this money to show people how you invest, but doing it right at the top of the market feels somewhat risky, almost that you are on a hiding to nothing in a way. You're going to probably lose money if the markets crash. But I could have sat there and kept doing that. But following process, putting money into the market, and of course we are where we are now, up over 50%. And the point is that you can use tactics like dripping money into the market. We talk about pound cost averaging if you're worried about the volatility in markets. So we'll put links to shows where we talk about those concepts like pound cost averaging. But the main thing is to be invested in the market. Now, the other one is the investor's worst enemy is not the stock market, but his own emotions. So his or her own emotions. That, again, speaks for itself. One thing when you see markets go up and down, there is always a tendency for you to become emotionally involved and make a knee-jerk decision. I say always a tendency. I should say there is a danger. And that's why I don't look at my portfolio regularly. I will only look at it typically about once a month and then decide if I'm going to do anything with my portfolio. But in the long run, you shouldn't have to look at your portfolio. Even once a year would be sufficient if you're only going to review it then. If you're following a passive strategy, for example, it's invest and forget. So those parts of my investment portfolios where I'm putting it into passives, I would just never look at it. I just regularly contribute to it. So be aware of emotional decisions that you could possibly make and try and mitigate that. Again, following processes. It's not about timing the market, but timing the market. Again, an anonymous quote. That's all about being a long-term investor. So if you keep dipping in and out, the chances are you're going to miss those bounces. You'll see research that shows that the best days in the stock market regularly follow in short succession after the worst days in the market, because again, your markets sell, they tend to oversell, and then they'll pick back up again as people buy the dip when you get towards that bottom. So that's again triggered by emotional decision making. People panic, sell at the bottom, and then people step in. Normally seasoned investors start to buy things when they think they're cheap and the market picks up. Next, risk management is the key to survival in financial markets. That's about diversification. So managing risk. I always think about the idea that if you are worried about your investments at night, you're not sleeping, you're worried about market sell-offs, or you're worried about the fact that you might be losing money or might lose money, then you're taking too much risk. If you're worried that markets might go up and you're not going to take advantage of that, then you are taking too little risk. So risk management is key. Don't look for the needle in the haystack, just buy the haystack. That was obviously John Bogle, who was the founder of the Vanguard Group. So it was really seen as the godfather of low-cost passive investing, which obviously is a very good piece of advice. So passive investing for the long term, just buy the market. You buy a tracker, for example. You get recessions, you have stock market declines. If you don't understand that's going to happen, then you're not ready. You won't do well in the markets. That was Peter Lynch, who's a former fund manager and also author. That's, again, about understanding investment markets. It's a bit like I always tend to say about if you're going to surf, then you're going to have to get wet. And if you don't understand that fact, you shouldn't be on the water. Similar sort of idea. The stock market is filled with individuals who know the price of everything but the value of nothing. That was Philip Fisher, who was a renowned investor, of course, but talking about the idea of finding value when you're investing in something, which will lead nicely onto Warren Buffett's lessons in a second. The biggest risk is not the risk itself, but the failure to mitigate it. That is a reference again to the potential for risk and diversification, so buying a range of different assets. It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. So that's George Soros again. The market is a device for transferring money from the impatient to the patient. I like that one. And so the lesson there is patience is key if you want to be a successful investor. There are going to be ups and downs in markets, but holding for the long term. Markets do tend to go up over time. So the longer time frame you have, the more risk you can take if you're comfortable with taking more risk, but be patient. A good example of this was the pandemic. So the post-pandemic era, everybody wanted to become an investor. So do you remember there was a period where if you look at companies' results, so look at some of the platforms, they had record years in terms of new customers because people had furlough payments, they weren't spending money, so people started speculating on the stock market. And then markets were started to rebound, it started to go up. But then obviously, as inevitably happens in these sort of scenarios, you have a pullback, people started to lose money, people panicked. We then, in subsequent years, had market fall again when we got to 2022. People started bailing out of markets, they'd lost money, they were not patient enough to wait for markets to recover, but more importantly, just to ride these ups and downs. And so they lost money, bailed out, and what ended up happening is the people who bought in at the lows, they may have dripped money in over time. They are the patient people who would have picked up things at a good price or cheaper that inevitably rose over time that we've seen since. So patience is important when it comes to investing. Otherwise, you make knee-jerk decisions. And the thing I worry about, there are a lot of people after the pandemic who will have been burned slightly because of investing in just single stocks rather than buying a diversified portfolio. And those people may never come back to investing and be able to grow their wealth. So that is something, unfortunately, I think we're going to see in the period going forward. Now, I'm going to move over to Warren Buffett. So Warren Buffett is known for loads of different quotes on investing. If you go to episode 291 of this podcast, I'll put a link. I listened to the show before coming on to do this one, and it was a really good roundup of lessons from Warren Buffett's style of investing and his career. I included a couple of quotes that he'd said, 3 of them, but I've got some more here actually, different ones. But the lessons from Warren Buffett are definitely worth listening to, so go listen to that podcast. But the lessons from his quotes, this one is just almost comical. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And that is more about avoiding drawdowns as well. So avoiding losing money, if you can, that will probably in the long run, well, it will increase your returns. I mean, it's easier said than done, but I think it's more about not taking excess risk. His most famous quote is probably, "I will tell you how to become rich. Close the doors. Be fearful when others are greedy. Be greedy when others are fearful." So that is the idea that people tend to, rather than buy at the lows and sell at the highs, they tend to do the opposite. So when the market is at the lows, they sell and panic, but then when they go and buy at the highs, because they're obviously getting greedy and jumping into the market, fearing that they're going to miss out. So that is the opposite that you should be doing. You should be buying low and selling high, of course. Warren Buffett, other famous quotes include, "The most important quality for an investor is temperament, not intellect." I like that because I do think there are a lot of people who think that investing is difficult and it's not for them. And you've got products out there in terms of robo-advice propositions. You've got things like Vanguard, lots of trackers. Investing is for everyone. You can buy a diversified portfolio now incredibly cheaply.
On that, when I think about investing, it being difficult, I've had conversations with friends and they broach the subject of investing. They've got some spare money and they say, it's not really for me. I'm not going to get into it. And I say, well, have you got a pension? And they'll say, yeah. I said, well, you're already investing.
Yeah.
And then that's a really good way for them to go, oh, okay. So my pension fund is taking risk. It's just that I'm not sort of actively involved with it.
Yeah, and I think people confuse investing with like day trading, when owning stocks, owning bonds, owning a portfolio of investments is actually investing. So it can be boring and should be boring. The quotes I've already read out explain that from successful investors. And as the quote from the founder of Vanguard said, well, if you don't know what to buy, you buy the whole market. And that is possible. And of course, it never used to be possible or as easily accessible to ordinary investors, so armchair investors. So now you don't have to pick the next stock or company to back to become the next big thing. You can buy them all already. And the thing that I find interesting, you get people who understand companies in terms of what their products they sell. Apple, for example, and they might love what they do. They might have all of the Apple's products, yet they would never think about investing in Apple. And so I'm not saying you go and invest in the things that you buy as a consumer, but these companies and these large companies, Apple in particular, have a huge influence on the market. You don't have to just buy a single company, but you will spend lots of money and be one of their customers, and they make lots of profit from you. You can actually share in that profit by owning some of their stock. So risk comes from not knowing what you're doing is another Warren Buffett phrase. That is true if you do something very crazy, esoteric, take too much risk. But if you don't know what you're doing, again, you don't have to. You can use some of these robo-advice propositions. You can use things like trackers, build portfolios. There are tools, articles that we'll link to. So anyone can do it. I think if you try and do something that goes beyond your own understanding, know what your limits are, know what you understand, try and learn more, but you can get somebody else to do it for you very cheaply. Days gone by you couldn't, but you can do now. Opportunities come infrequently, says Warren Buffett, but when it rains gold, put out the bucket, not the thimble. That's about capitalising on rare opportunities. I think that's quite a difficult one to put into practice, but it does emphasise about the idea that some of your biggest gains might come from parts of your portfolio. I think that's one way I'd like to look at that, not just a whole portfolio going up at once. You might have positions that do particularly well, and it's one of the reasons why I don't hold lots and lots and lots of different funds. I have a slightly concentrated portfolio at times, because it means that therefore if something like that happens, then I might have a bit of a bucket out rather than a thimble to take advantage. So I'm going to rattle through the rest of these. I'm conscious of the time. So the investor of today does not profit from yesterday's growth. That's really his way of saying don't rely on past performance. It doesn't predict future returns. Never depend on a single income. Make investments to create a second source. Now, I like that as a general rule if you're investing for income. So get a diversified portfolio of sources of income. So you get different income funds. So if one fund doesn't pay out at the same rate, it has to cut its dividends effectively or its payouts, then you will have a range of funds that hopefully, if they invest in different companies and different assets, you can have a sustainable income throughout your retirement, for example. But also, I just think that's a good rule to live life by. Have more than one income stream. Next is, if you don't find a way to make money while you're asleep, you will work until you die. That's loosely linked to investing, because your investments ultimately will hopefully provide you a retirement income. So life generally works that you end up getting paid for what you do when you're young, so a job, but then you move through life and you need to transfer to a point where you get paid for what you own. So you start building wealth and assets. So you then generate income from those assets. When you're young, you don't own anything, and there is a transition point throughout life. And I think what tends to happen, and it's become more difficult, I have to admit, for some younger generations to own things, property, for example, but they can own other types of assets when it comes to investing. But you've got to try and build wealth, trying to own things over time if you don't want to work until you die. And the next one is, do not save what is left after spending, but spend what is left after saving. So that's putting the priority on paying yourself first, which is a very good rule of thumb to live by. And finally, the best investment you can make is an investment in yourself. The more you learn, the more you earn. So those are the lessons from some of the best investors there have been in history. Some of them are actually quite good life lessons. So take those, learn from them, and hopefully you can become a better investor.